This video is brought to you by BlackNote Investment, my equity research platform, where you can find all the necessary data for company valuations. The automobile industry is composed of all those companies whose activities revolve around the development and manufacture of vehicles and vehicle parts. The vehicle manufacturing segment includes companies that manufacture cars, SUVs, light trucks, heavy-duty trucks, buses, and recreational vehicles. The vehicle parts manufacturing segment includes companies that manufacture engines, steering and suspension components, brake systems, transmission systems, seating and interior equipment, and all other key auto components. The vehicle body and trailer manufacturing segment includes companies that manufacture vehicle bodies, truck trailers and semi-trailers, travel trailers, camper equipment, and all other essential components of vehicles. The automobile industry is significantly affected by general economic conditions. Vehicles are durable goods, and the decision of whether to purchase a vehicle is very sensible. It may be significantly affected by sluggish economic conditions, geopolitical events, and other factors including interest rates, cost of fuel, and electric vehicle charging availability and cost. Market share is influenced by how products are perceived by customers in comparison to those offered by other manufacturers based on many factors, including price, quality, styling, reliability, safety, fuel efficiency, functionality, sustainability, and reputation. Notably, despite the presence of strong legacy automakers, the automobile industry is very competitive, registering a Herfindahl-Hirschman index of 0.03 or 333.6 points. The Herfindahl-Hirschman index is used to measure the level of concentration in an industry with HHI below 0.15 indicative of unconcentrated or very competitive industries. HHI between 0.15 and 0.25 indicative or moderately concentrated industries, and HHI above 0.25 suggesting that industries are highly concentrated or scarcely competitive, like oligopolies. Although in recent times, supply disruptions have resulted in near-term upward pressure on new vehicle prices, the industry has historically had a very competitive pricing environment, driven in part by excess capacity. For the past several decades, manufacturers typically have offered price discounts and other marketing incentives to provide value for customers and maintain market share and production levels. From 2013 to 2023, the industry's revenues grew at a CAGR of 4.3%, increasing 1.53 times from $2.52 trillion to $3.87 trillion. As of the end of 2023, the industry's operating margin stood at 7.1%, reflecting better performance with the industry median value of 6.5% of the past decade. The total operating profit was $275.8 billion in 2023. Looking at other measures of profitability, in 2023 the gross margin sat at 18.8%, in line with the median value of 18.8%, while the free cash flow margin was 2.4%, better than the past decade's median value of 1.5%. Collectively in 2023, the free cash flows to the firm registered a value equal to $93.5 billion. In the automobile industry, free cash flows are highly influenced by the ability of automakers to manage working capital needs, as changes in inventory, account receivables, and account payables are crucial determinants of how much cash a company can generate. The cash conversion cycle ratio is a good metric to compare automakers' ability to manage working capital, as it measures the length of time it takes a firm to turn inventory investments into cash. Among the top companies operating in the automobile industry, the median CCC ratio is 27.3 days. The lower the CCC ratio, the greater the firm's ability to generate cash from its operating activities. It implies that firms with low CCC ratios have lower reinvestment needs in working capital and thus higher free cash flows. It's not absurd to find companies with higher free cash flows than operating income due to negative CCC ratios, as it would indicate that their working capital needs are indirectly entirely financed by suppliers, granting them longer payment periods than the period it takes for automakers to sell finished vehicles and collect cash from customers. However, negative CCC ratios are unlikely to be sustainable in the long run. As regards solvency ratios, the debt-to-enterprise value ratio for the automobile industry is 16.6%, while the debt-to-equity ratio is 36.1%. The interest coverage ratio instead, showing how much the operating income covers interest expenses, is equal to 10.48, which would translate into a credit rating for the automobile industry equal to AAA based on Moody's rating standards. Finally, the unlevered beta of the automobile industry, which is the beta depurated by the debt leverage, has been 0.65 for the past 2 years and 0.86 for the past 5 years. Despite lower than anticipated electric vehicle adoption rates, which have led legacy automakers to adjust spending, production, and product launches of new energy vehicles, it's clear that NEVs are the future of the automobile industry, with automakers that sooner or later will be forced by legislators to cease the production of internal combustion engine vehicles to promote more sustainable means of transportation. Other than a secular switch in vehicles' powering systems, which will boost the sale of new vehicles throughout the next decade, emerging economies, especially Asian ones like Thailand, India, Indonesia, Taiwan, and China for a lesser part, are expected to drive the demand for new cars. To capitalize on such opportunities, over the past decade, collectively the industry registered a median reinvestment margin of 4.5%, which comprises investments made in capital expenditures, R&D, and acquisitions. In terms of efficiency and return on investments, the automobile industry's median sales to invested capital in the period 2013-2023 is equal to 1.16, meaning that on every dollar invested, the industry generates 1.16 of revenues. Combining both the reinvestments made through the past decade and the industry's ability to generate a return from the investments made, the 2024 expected growth rate for the industry is 5.1%. By 2033, the automobile industry revenues are expected to reach $6.07 trillion, increasing 1.57 times from the $3.87 trillion registered in 2023 at a CAGR of 4.6%. We projected the industry's expected revenues 10 years from now, applying the expected growth rate of 5.1% and allowing it to slowly decline as the industry approaches the economy's perpetual growth rate, represented in this case by the USD risk-free rate. Automakers are subject to a complex set of regulatory regimes throughout the world in which vehicle safety, emissions, and fuel economy regulations have become increasingly stringent and the related enforcement regimes increasingly active, ultimately affecting vehicle sales and profitability. Other than broad market regulations, the automobile industry is at the mercy of geopolitical tensions, primarily between China and major Western economies, which culminate in trade wars and the enforcement of tariffs on exported goods. To help Chinese manufacturers overcome the severe economic downturn which has been affecting the country in recent times, the Chinese government has bestowed upon the industrial sector, including the electric vehicle segment, massive support measures. This support comes in many forms, from subsidized loans to tax incentives, with the results being pouring money into Chinese manufacturers' pockets, lowering production costs, and enabling them to sell goods at lower prices to attract more customers. Ultimately, this flow of seemingly free money significantly increased the competition in the Chinese automotive market, driving down prices. However, due to the poor internal demand, Chinese automakers like BYD have seen fit to sell their low-priced goods overseas, especially targeting Europe, raising concerns of unfair competition and national security threats among Western governments. EU's response didn't take long to arrive, as it imposed tariffs on Chinese imported vehicles ranging from 17.4% to 38.1%, depending on the degree of cooperation shown by Chinese automakers in admitting unfair state support, which would add to the already existing tariff of 10% on cars imported into the EU, bringing the maximum tariff to a whopping 48%. Although the EU aim is to prevent a price war among European automakers to counter Chinese subsidized vehicles, which would inevitably drive down profits and limit future investments, Western automakers, especially those operating in the premium segment less impacted by new cheap vehicles entering the market, openly criticize the tariffs, arguing that any retaliation from the Chinese government on Western imported vehicles will inevitably deteriorate the sales and profits of legacy automakers, which heavily rely on the growing Chinese economy to sell their cars. Given the risks imposed by geopolitical tension, automakers are expected to increase their presence in markets in which their vehicles are sold, expanding production capabilities beyond their home markets, and reducing their exposure to trade restrictions and tariffs. The industry is highly competitive, and no company has a dominant position. The following table provides a snapshot of the top 30 companies in the automobile industry, accounting for 75.2% of total market share by revenues. Basing our assumptions on analysts' expectations and industry trends, we have estimated the future market share by 2033 for the top 20 companies operating in the industry and how their market position will change compared to 2023 levels. The shift towards NEVs will shake the hierarchies in the automobile industry. Companies like Tesla and BYD, which are heavily investing in NEV technologies, are expected to gain significant market shares in the coming years. The rise of NEV manufacturers will happen at the expense of legacy automakers still too focused on ICE vehicles, deceived by the illusion of maintaining good profitability ratios, as ICEs have higher margins than NEVs, instead of budgeting greater resources to the development of NEVs to capture future growth opportunities. If you are looking for financial data to support your valuations, on BlackNote Investment you can find the expected growth rate for 37 different industries used to forecast companies' future revenues. Additionally, the site offers useful data such as equity risk premiums for 39 different countries, used for calculating discount rates, as well as expected earnings growth rates for those countries based on analysts' expectations. Detailed industry and sector reports are also available, containing data like total revenues, total free cash flows, median operating margins, return on capital, as well as beta and financial ratios used to assess companies' risk. Feel free to use them in your analysis.